honest with you, it's one of the hardest chapters of all. And so you really need to make sure that you read this chapter and the sections that I specify to read. One main thing I want to point out here while we're getting started is that up to this point we've just been talking about owner's equity, and when we talk about owner's equity, that's really like the net worth of a company, what's the leftover that the owner could get. Well, when we're talking about a corporation specifically, that owner's equity is called stockholders equity. So it's really the same thing. It's what's left over for the stockholders, but now we're going to call it stockholders equity because it's a corporation. There's two main sections of the stockholders equity section. The first is paid-in capital. Paid-in capital is contributed by the owners of the company, and it's going to be either common stock or preferred stock, which we'll talk about in a moment. And then earned capital is called retained earnings. So this is after we close out net income into equity. Net income portion is going to be what we earned, and that goes into an account called retained earnings. Whenever we pay dividends, we pay them out of retained earnings. So what's left over is what's not been distributed. So here's a little reminder about the owner's equity calculation. So we start with beginning owner's equity, which for a corporation we're going to call it stockholders equity. So we start with beginning stockholders equity just like before. You're going to add net income or subtract a net loss, add any investments, which are paid in capital, and subtract dividends, which are like withdrawals. So our withdrawals in a corporation are called dividends. And then we'll end up with ending stockholders equity. So that formula is the same as owner's equity. We're just some of the titles of the accounts are different. Another key thing that we're going to be going over is different types of stock for a corporation. So when a corporation gets started, they have a charter. And the charter is a document that will specify how many shares that the company is authorized to issue to stockholders. So shares are like a piece of paper that says you're an owner in this company. So you could be an owner in Starbucks or Microsoft or Amazon, and you will get a piece of paper that is a share. For every share you own, a piece of paper that's called a stock certificate that'll say you're an owner in the company. Well, the charter will limit how many shares can be issued. So those are the shares authorized. And then that doesn't mean that all of those are issued. Later, the board will decide how many to issue, and they don't all come out at the same time. Will be issued at different times. So when shares are issued, they are actually in the hands of the stockholders. And then the corporation can buy back some of these shares. This is called treasury stock. And so this would reduce the number issued because we're taking them back. So what would be remaining is shares outstanding. So there's 4 different types of shares you're going to see: authorized, issued, treasury, and outstanding. And so make sure you understand the difference. This little example I have here is the charter could say the company is authorized to issue 1 million shares. Authorized. And then later they actually issue 10,000 shares. After that, they decide to buy back 1,000 shares. So as of now, there's 1 million authorized shares, 10,000 shares issued, 1,000 shares in treasury stock, and 9,000 shares outstanding. So you get the outstanding shares issued minus the treasury stock is what's outstanding. All right, another key terminology is this idea of par value. So on every stock certificate that you get that says you're an owner in a company, it's going to have a printed price on it called the par value, which is like the base price of the stock. Now, a company can issue stock below par value, but that's not something that we're going to cover in Chapter 13, and it's also not really common, and so we're not going to cover it. We're only going to be worried about stock that's either issued at its par value, the value listed on the stock certificate, or an amount above par value. Okay, and then there's two different classes of stock that we're going to be covering. We'll be covering preferred stock, and preferred stock just gives anybody who owns these special preferred certificates has special dividend rights, and they get dividends before the common stockholders get dividends. Okay, so let's start with preferred stock. There's really two different types of preferred stock that we're going to cover. One is cumulative preferred stock, and the other is non-cumulative preferred stock. And the difference is cumulative preferred stock will accumulate even if you don't get paid. So an example of that would be you are an owner in a company, you're a preferred stockholder in a company, and your stock is cumulative, but the company doesn't pay dividends this year, and so they don't pay dividends in the second year, and in the third year they decide that they're going to pay dividends. Well, if you have a cumulative preferred stock, you get the dividends you were supposed to get in year one, supposed to get in year two, and you get year three. Like, they keep rolling over, and even if the company doesn't have cash to give you, you'll get it later. If it's non-cumulative, if the company doesn't declare a dividend, you just don't get it for that year. So here's an example of that. We have a company that has 1,000 shares of cumulative preferred stock, okay, and 4,000 shares of common stock. So we have two classes of stock. The way that you read this preferred stock is it's cumulative preferred $4 stock, $50 par. So the par is what's printed on the certificate, and the $4 is the dividends paid. So this will be $4 per share owned. So that would be $4,000 because we own 1,000 shares and they pay $4 of dividends. So if it's cumulative preferred, that means that every year we're going to rack up $4,000 whether the company has the cash to pay it or not. If they don't have the cash this year to pay us a dividend, we'll get it next year or as soon as they declare a dividend. And then common stock has $15 par printed on the certificate. Now, the certificate price or the par price is going to tell you which account that later we're going to make a journal entry for. So we'll keep that in mind. One other thing before we do this problem is that sometimes in a problem it'll say $4 stock, so it'll tell you how many dollars per share. But then this is another example of how you might see this same problem listed. It might say 8% $50 par. And this is the same thing. What you would do is you'd say $50 of par times 0.08 in your calculator, so 8% is $4. So you could see it either way. These things are the same thing. Either way, we're going to pay $4 per share. So for this company, we have in 2014, no dividends were declared. And then in 2015, no dividends were declared. That means nobody got paid. And then in 2016, the company declares dividends of $22,000. So let's see how this would work out for our preferred shareholders. In year 2014, no amount was distributed. So our preferred stockholders got nothing. And if our preferred stockholders got nothing, our cumulative stock or common stockholders also got nothing. So then we need to determine how much dividends are in arrears. Arrears just means how much are we going to owe in dividends later. Well, up here we calculated that the preferred stockholders are supposed to accumulate, so cumulative, $4,000 every year. So even though they didn't get any, they are going to accumulate that $4,000 and get it later. Okay, 2015, no amount distributed. Preferred stockholders don't get any. Common stockholders don't get any. So how many's in arrears now? Well, you still have dividends from year one, and they didn't get paid in 2015. So now there's $8,000 in arrears. So when we get down to 2016 and there's $22,000 declared, that means that's how much was distributed to all our stockholders, our preferred and our common. We pay the preferred stockholders first. So what's going to happen is year one, we were supposed to pay them $4,000. Year two, they were supposed to get $4,000. And this third year in 2016, they're supposed to get another $4,000. So together, they get $12,000 in 2016. And the preferred stockholders are going to get that before common stockholders get paid. So then whatever is left over is what common stockholders get, $10,000. So there's no more left in arrears, and we have now distributed all $22,000. So now let's just see what is that per share that everybody got paid. Well, dividends per share is a formula that you're going to need to know, and that is dividends paid as your numerator, and the number of shares is going to be your denominator. So let's do preferred stock first. It's going to be $12,000 was paid divided by 1,000 shares outstanding. This should be shares outstanding. Okay, so that is $12 per share that the preferred stockholders got paid. So if you were an owner in this company and you owned 100 of those 1,000, then you would have gotten $120 as a preferred stockholder. What about a common stockholder? So the common stockholders got paid $10,000, and there are 4,000 shares of those. So actually, common stockholders only get $2.50 per share. So that is how you divide up the dividends if you have a cumulative preferred stockholder. If this was not cumulative, then you would not have these arrears here to pay later. And the common stockholders would have gotten more in the third year. Okay, so now we're going to go over different types of journal entries that you're going to run into throughout this chapter. So I'm going to give you different examples and show you what the journal entry would be, and in other similar situations you ought to be able to use these as examples for your journal entries. So the first thing that we're going to talk about is, what if we are issuing stock? And the reason that we would issue stock is because our company needs money. So we need money for our corporation, so we're going to issue a bunch of pieces of paper to all these stockholders, and they are going to give us cash. And then we're going to use that cash to maybe add new locations, build our operations, pay our executives, pay our people. We're going to use that cash that's coming in to better the business, or supposed to use it to better the business. So when we are issuing stock, we are looking to receive money into the company. So this first example, we have issued some stock. We issued 5,000 shares of preferred stock and 50,000 shares of common stock. So the first thing that you want to do, if it's issued at par, is we want to know how much cash is that. Well, 5,000 times $100 par is 500,000. 50,000 shares of common stock times $20 par is $1 million. So we got $1.5 million in cash. So you'll first figure out, that's what I always like to do, how much cash did I get? Well, we got $1.5 million, so that's going to be my debit. And then the credits go into the specific stock accounts. And this example is easy because we issued it at par. But par is the only amount that's going to go into these stock accounts. So common stock was $1 million, and preferred stock was 500,000. So there's your journal entry if you issue at par. If we issue for a premium on stock, that means that the market value, the cash we're going to get per share, is more than the amount printed on the stock certificate. So here in this example, we issued 2,000 shares, and there's $50 par printed on the stock certificate. But because of the demand for this company, we are able to sell it for $55 per share. So $5 more per share than is par printed on the certificate. Let's first figure out how much cash did we get. Well, we had 2,000 shares, and we sold them for $55 each. So that's a debit of $110,000. Next thing we need to do is only put the par portion into our stock account. That's all that goes into the stock account. So we had 2,000 shares at their par price is $100,000. So we're going to put the stock portion, or the par portion, in our stock account. Anything that's extra, we put into an account. It's a new account. It's called paid in capital in excess of par. So this is that extra $5 a piece that we got for each stock, and that's the extra 10 is going to go into that account. Now, we could also issue stock for other property. So we might issue stock for land or equipment instead of cash. So when you see that, what you want to do is figure out the value of the property you received. It's almost like you know how much cash you got, but like how much value in the property did you get? Here we have 2,000 shares of common stock that we issued. It has $50 par printed on the certificate, and we got land in return instead of cash, and that land is worth 120. Well, here I have it that the stock is trading for 120. So if the stock is trading for 120 per share, then we're going to assume that that's the value of the land. So you would say 120 times 2,000 is 240. Now, if we didn't know the fair market value, so let's say instead of, the fact we didn't know what the value of the per share price was that it was trading for, but we knew the value of the land. Well, then we would have put the value of the land here. So whichever one you know, that's what you're going to use. We could have used either. So here we know that the stock is trading for 120. So let's put only the par portion of 50 into our stock account, which is $100,000. And the additional paid in capital, so I like to abbreviate that PIC, paid in capital in excess of par for our common stock is the extra 140 that we got. Okay? Now, in some states, they don't require a par value to be printed on the certificate. So it really just depends on the states. So this is something that's governed by the state. And so they would just say, no par necessary. Well, then if we issued 1,000 shares of common stock at $40, that's the value or the amount we got per share. So the cash is 10,000 times $40 is $40,000, we just put all of that into common stock because we don't have a par printed. And some states don't require you to do that. Now, in some of those states that don't require a par value to be printed on the certificate, they say, but you do have to have some stated value. Well, whenever you see that something has a stated value, you're going to treat it just like par. It's the same thing. So here's an example where we have 1,000 shares of common stock, no par, but has a stated value. So that's still going to be printed on the stock certificate. It's just called stated value instead of par. Really, it's just a state difference. And we sold them for $60. So what we're going to do is figure out the cash amount we got. 1,000 shares at $60. That's $60,000 that we got in cash. And we're going to put the stated value of 50 into the stock account instead of par, because we don't have a par, but we have a stated value. And then our paid-in capital account is going to be called paid-in capital in excess of stated value, which is the extra 10. So that looks a lot like those par value problems. Okay? There's some journal entries I want you to know when we're paying dividends. There's 3 main dates that are important when we pay our stockholders dividends. First is the date of declaration. The board members who run the company, the board is in charge of running the company, and they decide to declare a dividend. At the day that a dividend is declared, that is the day the dividend becomes a liability. Not the day we pay it, but the day we declare it. So let's say we have a board and they declare a $40,000 dividend. So on the date of declaration, we would make a journal entry, $40,000 cash dividends is your debit, and cash dividends payable, which is a liability, is your credit. The third date is the date of record. Now this is a really important date because if you buy, let's say you buy the stock here after the date of declaration, but before the date of record. This date of record is basically a list of people who are going to get the dividend. So to be on the list to get the dividend, you have to buy it before the date of record. So you could buy stock knowing it's going to get a dividend paid because it's already been declared, but you have to buy it before the date of record. If you do this during this time period, this is called selling with dividends. Now you could also buy the stock here, so before the date it's paid, but after the date of record. So you are not going to be on the list. You'll still own the stock. You're just not going to get the dividend when it's paid. This is called selling ex-dividend. There is no entry for the date of record, but on the date of payment, we're actually going to pay the cash, so that's a credit of $40,000, and we're going to remove the payable with a debit of $40,000. Okay? We could also not pay our stockholders cash dividends, but we could give them more stock instead of cash. So this is a good thing. So in this case, we're basically taking retained earnings that we would have paid a dividend, and we're putting it into paid-in capital. So total stockholders' equity does not change when you pay a stock dividend. So we're essentially saying removing the 40 from retained earnings, and instead of paying that to stockholders, we're actually putting it up here in paid-in capital. So your total stockholders' equity is going to equal the same amount as before. Here's an example of that. Let's say we have a company who has a stockholders' equity section on their financial statements that looks like this. So they have $75,600,000 in total stockholders' equity, made up of common stock of $40 million, paid-in capital of $9 million, and retained earnings of $26,600,000. The board gets together and they say, we're going to declare a 5% dividend. So that's not cash, that's 5% stock. So if we had 2 million shares, which you could figure out how many shares outstanding we have, because you could say, all right, if there's a balance in this account of 40 million, and we are only putting the par portion in this account, then you would just say 40 million divided by 20, that's 2 million shares outstanding that we have. So you could figure that out. So long as you have 2 of these 3 pieces of information, you could figure out the third if it were missing. So here we know we have 2,000 shares, and 5% of all the shares outstanding is 100,000 shares. So we're essentially going to give out 100,000 more shares to our existing stockholders. So here's how that would work out. Well, we'd look at what's the market price. It's selling in the stock market for $31 per share. So $31 per share times 100,000 shares. That's how much our dividend is. The value of our stock dividend is $3,100,000. So we would debit an account, stock dividend. Since it's not cash, we won't debit cash dividend, we'll debit stock dividend. And we'll put the par portion into an account called stock distributable. So only the par portion is going to go into that. So that's your 2 million. Oops, no, it's 100,000, sorry. 100,000 times the $20 par is the par portion. Anything extra goes into a paid-in capital account. There wouldn't be any entry on the date of record, but then on the day we distribute it, we will remove the $2 million out of stock dividend distributable. That's kind of like our liability or our payable account. So we'll remove it when we pay it, but we're not really paying it, we're handing out more certificates. So we're increasing our stock. So look at what happens up here. So now we've got 2 million that we just added to our stock account. So now that's 42 million. And we added 1,100,000 to our paid-in capital account. So now that's 10,100,000. And we removed 3,100,000 from retained earnings, because that's like distributing out of retained earnings. So now it's down to 23,500,000. And if you add all this up, you'll see that our total stockholders' equity didn't change. We just moved 1,100,000 into paid-in capital and 2 million into our common stock account. So I know that's a lot of information in a long video. I would encourage you to watch it more than one time, and do look at the practice that I post for chapter 13 and work through all the practice before you attempt the homework. So let me know if you have any questions, and good luck on your homework.